On the phone line from Hong Kong. Hi Ben, afternoon, and thanks for taking the time out and answering our phone. What's been the key reason for this 7% fall that we're seeing in the Chinese markets?
Sure. Actually, the China market was particularly weak. Despite overall, I think the market is not that good performing. But the China, especially Asian market, is down like over 8% today, which is quite significant. I believe that it was triggered by several factors. The most impactful one should be that we were approaching the 4,500 level before this short-term correction. Actually, that is a level that people were worried about. National team will start to sell the stocks they bought. So actually, people know that during the turmoil of China markets in mid-June to early July, we had a national team which was funded by the bank's loan and the central bank money. Actually, they bought a lot of stocks from the market, and the people worried about it. They were started to sell it when the index level was about 4,000. So actually, that gave a selling pressure from other investors. And on the other hand, IMF suggests the China government to exit the bailout measures as soon as possible. Actually, that's actually a concern of domestic investors because they believe that will create some pressure to China government because they still wanted the currency to be entering the SDR basket. So actually, that if they want to exit the bailout measures soon, then inevitably the market will be under pressure because they need to sell. And on top of all this, and recently some investors are quite concerned about the pork price, which actually may create a higher inflationary pressure in China in second half, which may curb the room for further monetary easing from different investment perspectives. So actually all this creating some relatively cautious sentiment all over the market today.
Hi Ben, good afternoon. This is the biggest intraday fall since 2007. So what's the sense you're getting from speaking with local analysts, whether in Hong Kong or Shanghai, about how much more weakness there could be in store?
Okay, so far I think the people are getting more cautious, but overall speaking, a lot of analysts still believe that the 2,500 Shanghai Composite should be the near-term bottom, because that was the level last time government stepped in and showed the determination they would like to stabilize the market at that level. So it could be relatively a resilient level because government may started to buy back shares again at that level, in my view. And that means that if everybody wants to accommodate the actions from the regulators or government, then a lot of investors will buy at a similar time. So actually there will be sort of a feeling to make that level a relatively resilient level for the Shanghai Composite Index. But on the other hand, I believe that after the quick correction, if the market drops below that level, I believe a lot of leveraged positions, for example, margin loans and some other like equity swap and other like off-book margins will be forced out again, which may create another snowball effect, which we saw a month ago. I think that is definitely what the government doesn't like to see. So I still believe they will take some actions if the market further drops below to that level.
Ben, could you just give us the key level again, which you're watching?
Sure. What?
You said that there is an important level in the Chinese markets below which you will see a lot of unwinding of leveraged trades. Could you just give us the number again? What level?
Okay, so far the margin loans is about 1.4 trillion still. This is the RMB, Chinese yuan, 1.4 trillion. It is still relatively high.
No, I think
I was asking was the level on the Chinese index, on the Shanghai Composite.
Okay, so the last time the government stepped in when it was about 3,500 Shanghai Composite Index.
All right. So that's the key level. Okay, just one final question. Do you see this weakness in the Chinese markets hurting the rest of the Asian markets, which basically means that if China continues to fall, do you expect the rest of the Asian markets to be in a downward trajectory?
I think that may create some downward pressure for the rest of the Asia. First of all, people do worry about the growth slowing down in China, which will impact the economic growth for other Asian markets, in my view as well. And also, as I said, the government may have will face some monetary easing hurdles if the pork price in China continue to rise. In that case, they can't do a further stimulus and the monetary easing if that materializes. I think then the impact will be even bigger to the rest of the market, given the hope of the China economic growth recovery will be delayed.
All right, Ben Bei, appreciate your thoughts this afternoon, and thanks very much for